Welcome to TheoTrade. This is Don Kaufman, December 11th, 2021, doing the TheoTrade weekend update on a Saturday morning. Should you fight the Fed? Of course, that is going to be the topic of conversation for this entire next week of trade. FOMC meeting kicks off. Okay, into Tuesday, Wednesday. Wednesday, we'll have the FOMC announcement, a press conference by Jerome Powell, who is now, of course, with us for the next couple of years. However, a major shift in Fed policy forthcoming. And as you guys know, the old adage is don't fight the Fed. And yet, well, we're going to discuss that here momentarily. Before we get there, let's just discuss a little bit of this past week of trade, or should I call it the absolute quintessential rip your face off rally. Market obviously rallies back just shy once again of all-time highs, but the magnitude of the move is fairly incredible. And again, what you're looking at right now is the SPX. And for those of you that tune in on a week-to-week basis, we look, of course, at these expected moves. And if you look at the expected move of this past week of trade, you are looking at plus or minus about $157 move. People, we got that and then some. We actually closed ever so slightly outside of the upper edge of the expected move. But something I often point out, and I actually want to come into this and zoom into, this is now intraday, 1 day, 1 minute. I'm actually going to back this up just a little bit, knock the time frame out from 1 day, all right, to ultimately the entire week and take it all the way down to a 1 minute. And one of the aspects that I wanted to show you is once we hit the upper edge of the expected move on the week, okay, that was the entire story of the week. On Monday, we started a rally. On Tuesday, we hit the upper edge of the expected move. That was it. Tuesday, Wednesday, Thursday, into Friday. Friday, all right, a little bit of a burst to the upside. The reason I'm going through that is a lot can be learned, of course, about trade, but when you're hitting a major inflection point like the upper edge of an expected move, and that's what the option markets denoted risk to be. For the most part, you got to look at these expected moves and recognize there is massive skin in the game. Billions of dollars are in play right at the edge of an expected move, because that's, for the most part, it's where buyers and sellers kind of meet. Now, there's tons and tons of really dedicated education specifically to the expected move. Nevertheless, again, as I said, it's where buyers and sellers meet. It's almost like a seam inside of risk. So we hit it and we just basically channel around it for the remainder of the week. This is something that we've seen just, week in and week out, hitting the upper edge of expected moves and just basically chopping around that. Nevertheless, again, just a wicked move to the upside. But this entire move inside of the marketplace, and I want to start to put it into a little bit of perspective. All right. So yes, the S&Ps had a phenomenal recovery. Okay. The QQQs also recovered. But, okay, with all due respect, you know what? It was pretty much at par. The QQQ moved pretty much in line, if you will, with the S&Ps. But the entire move really came down to the monsters of tech. I mean, this is something that, if we haven't talked about enough, again, when I say the monsters of tech, you're looking at the same underlyings day in and day out, which is your Microsoft, your Apple, okay, Amazon to a lesser degree. Amazon has actually defected a little bit. Facebook defected a little bit. Google, okay, obviously Tesla, Nvidia. These are now the players in the room, which we're going to talk about here momentarily. So mega market cap, and I call it mega market cap. And again, a lot of people don't have like a huge amount of respect for a product like Nvidia. But again, with all due respect, if you take a look at Nvidia and it's a $750 billion market cap, have respect for the fact that there is just massive volatility in here. So Nvidia, even after the vol crush this week, and normally I come in here and discuss volatility an immense amount, but I'm going to push that aside for just a moment. This again, it comes down to market capitalization. You have a 53 vol against a $750 billion company. Compare it for a second to Microsoft. And Microsoft's another massive leader in here, but Microsoft is, it's about a 25 vol, so Nvidia has double the volatility. But then again, Microsoft has a $2.5 trillion market cap. That's right, folks, $2.5 trillion, can't be wrong. But wait, there's more. Apple is facing a $3 trillion market cap. We have come to insanity and gone well beyond. With that, okay, again, you have to have respect for Nvidia because it's not trading. Again, it's not trading like a $750 billion market cap. It's trading like double that. So you have to look at it almost like a $1.5 trillion company, which starts to put it, in the realm of some really big underlyings like, maybe not necessarily Apple or Microsoft, but again, it's definitely in that realm. And we start to talk about stuff like Facebook. And again, with all due respect, Facebook has actually fallen back to a $900 billion market cap. And yeah, it commands a little bit of volatility, but Nvidia means so much more. And then you bring up a monster like Tesla, and Tesla's actually sitting at about 65 vol with a $1 trillion market cap. And that's when you say, wow, I mean, this is the likes of, it's just as important as Microsoft and Apple happen to be. Nevertheless, with that, so mega market cap, okay, leads the move back to the upside. Now, let's not discount some of the move inside of financials. In fact, for auto expected moves, I like to put this in here. The financials did actually run to the upper edge of the auto expected move. And this is, again, it's what the option market depicted risk to be. So what did the financials do? Well, they did exactly what the marketplace was anticipating them to do. When you start looking at stuff like the monsters of tech, okay, they actually smashed the upper edge of the expected move. And again, let's look at some specific stocks. Microsoft, okay, leads the marketplace outside the expected move. Apple, okay, Apple, you're talking like 2 and 3 sigma type moves. And again, you have to understand that there's a statistic that everybody's throwing around this last week of trade. I'm going to bring it up here in just a moment, okay? But we have really come into a marketplace that this is it, people. It's just a tale of two totally different markets where when you get a $2.5 trillion company and it rallies, okay, 2 or 3 standard deviations outside of the norm, okay, it just drags the entire marketplace with it. Bottom line, okay, we have now a tale of two markets. And the statistic that everybody's been throwing around is 64% of a 23% year-to-date gain. And that was a little bit earlier in the week, the statistic came out. So 64% of the move this year in the Nasdaq was 23%, okay, is now down to just 5 stocks. It's Microsoft, it's Google, it's Apple, it's Nvidia, it's Tesla. And these are the things we talk about just day in and day out here at TheoTrade because, yes, you can trade other stuff. Okay, you can trade other stuff, but you have to start to put a lot of perspective on what has become two different markets. You have a marketplace that is not just in corrective territory in a lot of stocks. It's just an outright bear market. I bring up Zoom. Maybe that one's not fair. Okay, maybe we should bring up Zillow, which is possibly even worse. Okay, or, like the Pelotons out there. You have to look at the number of underlyings inside of the Nasdaq. I mean, these are just a handful that were, darlings, if you will, of the COVID era, which possibly we're still in. But again, we're already hitting some of the COVID era kind of stocks. Nevertheless, if you look at the entire SPAC market, it too is it's been decimated. Just absolutely decimated. One of the other ways to point out some of the SPAC market and decimation, if you will, and some of the high flyers, look no further than ARK. And I'm not here to pick on Cathie Wood because that is too easy. Anyway, even ARK Investment is down right now, almost 23%. And that's why I call this a tale of two markets, because as a trader, I think you have to have, appropriate consideration at this point when you have a handful of products, okay, that are leading us. And again, I've been extraordinarily critical of Google because if Google comes down, the entire market's coming with it. This is just hands down. And the other leaders in the pack now, you have to look at Microsoft, but Microsoft's up 57%. Apple, okay, Apple just a few weeks ago, let's again put it into a little perspective. A few weeks ago, it was up, but it was up so marginally on the year. And I say a few weeks ago. I mean, people, come on. We're only into, we're a second week of December, if you will. Actually, technically, this is coming into expiration this Friday, so it's the third Friday of the month. Nevertheless, we're a few weeks into December. You've passed through, October, November, but in mid-October, did you realize that Apple's only up 9%? Okay. And if you're not looking at the move inside of Apple, you're just not seeing what's driving the marketplace. And that's why I call this a tale of two totally different markets. Now, don't worry, we're going to get to the Fed here momentarily. But first, we have to paint the picture of, okay, you have mega market cap that is not just bringing the markets higher. It is the market now. It has become the marketplace. And I didn't bring up, the Zillow and the Zoom and the Pelotons and the SPAC companies to make any other point other than the fact that the marketplace is in very large part damaged. I mean, you've got a very damaged marketplace to where the only thing standing between us and some very extraordinary volatility are lovingly 5 stocks. Now, with those 5 stocks, let's get into some real specifics, okay? There's been really no weakness to speak of. I mean, if you talked about something like Microsoft and weakness, it's completely unscathed. I bring this up simply because if the market's going to start to get into a tailspin and we start to see some sell-side activity, this is a place that you're going to want to be. And by that, I mean, this is where you'd want to be bearish. It's in something like Microsoft. Where you'd want to be bearish, something like Google. Again, it's totally unscathed. Where you want to be bearish, maybe to a lesser degree, Apple, although Apple has had this just absolutely parabolic move. And again, this just, it reeks of retail trade in here. Do you smell it? Okay, why do I say it reeks of retail trade? Let me get really specific with you. When I say it reeks of retail trade, you look at the option marketplace. And by the way, the option marketplace, specifically on this past Friday, of course yesterday, was actually light. We only did about 70% of norm of the previous 5 days. Actually, option activity was relatively light this entire week. Retail was not as engaged, but the blaring statistic that you have to see here is traded at the ask or above. Almost 1 million contracts traded at the ask or above. All right, and you actually had 2.1 million calls and only 1 million puts trade, which is it's normal over the last couple of days. Nevertheless, the activity at the trade at the ask or above just basically means, if you have a market of $3, okay, at for instance 310. Okay, what it means to trade at the ask or above, that's the ask, okay? This is the bid. Everybody's just coming in here. They're just, I'll take it. I'll take it. It's 310. It's something I explain all the time. This is just retail orders coming in, and they're just market order, traded between the market. I mean, you think about this. 1 million contracts traded at the ask or above, right? 500,000 traded between the marketplace. I mean, how many retail clients, what point do you look at this and just go, that is awe-inspiring? The people are just coming in there using marketable orders and trying to buy up the marketplace. And the more calls they buy, the more the market-making firms have to hedge. Market-making firms hedging drives the stock. And again, we get parabolic in there. But my point is, and why do I say Apple to a lesser degree? Apple's only up 38%. You got to look at what the top performer is inside of the Nasdaq right now. And in terms of top performer, I'm sure that everybody's going to point out, what are you kidding me, Don? Look, Tesla. First of all, Tesla is up basically right now at par with where Apple is. People are going to point out Nvidia. Nvidia definitely commands respect. It's still up 130% a year-to-date basis. Okay, and again, we're looking at year-to-date basis percentage returns in here. So Nvidia definitely commands respect. Okay, but with all due respect, Google is the beast. Google is the absolute beast in here, being up 71%. And again, the market capitalization in here, and again, I'll pop up market cap. The market cap in here is just shy of $2 trillion. So even Nvidia, with 130% return, okay, is still, again, 130% return, but it has basically double the volatility. This acts more like a $1.5 trillion company. The real player in the room is clearly it's Google. Nvidia, though, is right up there with it. Now, with saying that, again, I'm trying to bring you to the stocks that mean the most right now to the marketplace, because everybody wants to know, if we start to go into a tailspin, well, if we start to go into a tailspin in the marketplace, you're going to know it. It is going to be stocks like Microsoft. It's going to be Google. It's going to be Nvidia. And now this is the little bit of a cautionary tale. The cautionary tale over here, okay, is risk reward is just wildly in jeopardy. And I'm going to keep this part fairly short and sweet. Bottom line right now, Nvidia is towards the lower end of a range. Okay, it has sold off now, and forget this huge spike up here at the 346 level. It's 335. It's come down about $35. So you've had Nvidia move into like corrective type territory, but specifically, and again, I like to get very specific. This 300 level, okay, is like a line in the sand. Once we start to get under it inside of Nvidia, this could see some dramatic sell side activity, and I would keep that in mind. And I would specifically keep it in mind this particular week, because we have been flirting with it. We have been closing at it. 300 is a line in the sand in Nvidia. So why should we care? Because again, you're down to 5 underlyings. You start to lose one, okay, and the Nasdaq is going to lose its power. Now, you have to also have respect for the fact that the Nasdaq is holding on to the gains of the S&P. Sure, financials mean a lot, not nearly enough. Financials are not going to hold you together. Financials are up 34% on a year-to-date basis. It's not enough. You look at energy, energy's up 50% on a year-to-date basis. These are not going to be enough market cap. Like, what do you got? What do you got inside of financials? Huh? What do you got? Berkshire Hathaway being one of the biggest ones in there. Okay. The other one in there, of course, is JP Morgan. Take a look at JP Morgan. Go over here to the market cap. The market cap is what? $500 billion. Okay. That's it. You have a $500 billion company. Okay, $500 billion company sitting with like a 26 vol ain't going to do it. It's just not going to be able to sustain in the marketplace. And that's what you have to have respect for, is that, again, the entire marketplace, and I say the entire marketplace because it really is. It's the S&Ps, is the Nasdaq, is largely predicated upon, one stock like Nvidia starts to break lower. The entire marketplace is in jeopardy. Now, which one is it going to be? Is it going to be Nvidia, which has come into a little bit of corrective territory, or are you going to start to look at Tesla? By the way, speaking of Nvidia at the 300 level, Tesla, the 1000 level, couldn't be cleaner. All right, two stocks, and they're both basically aligned to actually break a little bit lower. This week is actually going to be relatively pivotal for those underlyings. Now, why do I say that the risk reward is in jeopardy? And I want you to understand precisely what that means. Okay, we have lots of retail clients that are coming in here, swinging for the fences, and YOLO, buying some calls. Okay, fair enough, but would you actually want to go in there and jeopardize a huge amount of your account, based on the idea that this stock is going to continue to the upside? For me, that is not going to be a trading plan. That was going to be a recipe for disaster. What I'm much more concerned about, though, with risk reward in jeopardy is those that are outright long the marketplace. If you're long the marketplace, if you look at like upside potential, people, listen, we have a Fed meeting coming out. There is upside potential to this marketplace, but the downside risk, you can taste it, you can touch it, you can see it, because you only need one or two, okay, of these stocks, the Tesla, the Nvidia, the Google, the Microsoft. You only need one or two of those to break lower, to start to pull the entire S&P back. And the crazy part of this, right, is that this rally back, and again, this is the diabolical aspect of the marketplace I've been talking about just a huge amount, okay? This marketplace sells off, goes into a little bit of a tailspin. We see some volatility, bounces right back, okay? How many times do you have to see that to be a believer? And I got to tell you, this last week, even the most hardcore bears, I'm one of them. This is where you start looking at it and you're going like, it is never going to come down. The market is never going to sell off. I mean, everybody is starting to bite right now. Again, I talk about this Pavlovian, dog response. The bell goes off in the morning. Everybody goes, rally, right? And they show up for that rally. And you just get into that, that groove of, don't worry, my whole strategy right now is to buy that dip, And yet we're seeing defection in the dip buying in a number of places. One of those happens to be none other than in crypto. The crypto market right now, it's not just in a tailspin. I mean, this thing's in full bear market territory. For those of you that speak geek, that bear market territory, well, it was up over 117%. Now it's only up 52%. Nevertheless, it's still having a stellar year, but it's in some very, very rough shape at this point in time. All right, risk reward is definitely in jeopardy. And that though is for the entire S&P. That's not for the Nasdaq. That's not stock specific. It's for the S&Ps. You have to be concerned at this point in a 401k and an IRA. There's a tremendous amount of downside risk. So even if you're the most bullish of bullish traders, I'm fine with that. I don't want to be in here, okay, really, with implications to your own directional bias. You have to decide, how long-term you're going to be in this marketplace, okay? But at the same exact time, I'm going to say this: hedge now, forever hold your peace. Because if you don't mitigate risk and downside risk to some degree at this point in time, you're not seeing the fact that you have five underlyings, okay, that are supporting the marketplace. Two of those underlyings, Nvidia and Tesla, are hitting key inflection points that if they break lower, they're going to continue to sell off. All right, that's why I say risk reward is in jeopardy. Federal Reserve meets untamed inflation. switching gears a little bit. So the Fed is going to be out this week. Oh, go take a look at it on the calendar. We have the Fed. There's going to be a press conference. There's always a press conference now. Jerome Powell gets a little FaceTime in the media. All right, bottom line is the CPI number came in as expected, but it expected was hot, man. It was really hot, 6.8%. Okay, we are on fire in terms of inflation. So the Fed's going to have to make a decision. Okay, full employment. We're very close to it. It doesn't matter what you think. That's what the Fed says, right? Full employment. We're very close to it. They have to turn around now and fight inflation. Okay, so what they're going to do is they're going to taper at an accelerated rate. They're possibly going to move the dot plot and actually talk about rate increases. So the Fed has an impossible, okay, battle. Either you go after full employment, but if you start to full employment and support the economy, inflation is going to spiral completely out of control. Or you have to actually turn the fire hose towards inflationary pressures. And if you turn the fire hose towards inflationary pressures, that means actually contracting some of the money flow that's been in the marketplace, right? So they're going to go out there. All the bond buying they're doing must stop. Okay, they have to actually start to threaten the marketplace. The marketplace already sees this. Okay, the bid back or Fed taper smack. That's what I'm calling it right now. We have had a wicked bid back. Okay, that's the bid back. We've already had the bid back. Are we going to get a Fed taper smack, which would actually cause the S&Ps to, again, kind of go into that tailspin? And one of the answers can actually be found right here. If you look at this, and if you've never seen this site before, this is the U.S. Department of Treasury. Oh, it's an exciting site. Janet Yellen, here we come. One of the things that a lot of people are starting to see, do you know there's a very, very mild yield curve inversion? What you're looking at is a yield curve, right? If you look at the top of the screen over here, there's a 1 month, a 2 month, 3 month, 6 month. These are just, the rates associated, 0.03. But if you go out to like the 30 year is actually paying 1.8. The crazy part is the 20 year is now above the 30 year. So what have we gotten here? There's what they call steepening of the yield curve and flattening of the yield curve. And then there's inversion of the yield curve. We have a very, very, mild onset of an inversion of a yield curve. And this is something we're going to be watching carefully because the full-blown inversion of the yield curve, it's almost like the marketplace in, of course, bonds and the marketplace of notes and interest rates. They're almost like pricing in that the Fed is going to make moves. The yield curve will invert and will go into a recession. That's, and am I getting that all from just the 20 year versus the 30 year? No, but this yield curve has dramatically shifted, specifically also in the 5 year. By the way, the 5 year is critical to watch. So 5 year gets above eventually like that 10 year, and they have come close, people, because if you're taking a look at exactly what I am looking at here on the screen, look at that 5 year, okay, versus the 10 year. And again, take a look throughout the course of the last couple of days. This is just this month of trade, right? Look, the 5 year is actually exploding to the upside over here, where the 10 year has done absolutely nothing. So 5 years catching up to 10 year, those two invert, and it's often an inflationary sign being fought and actually flipping us back into a recession. It's again, curious over here to watch those interest rates. The statement about the Fed is how aggressive are they going to get and try to tame what is right now untamed inflation, and that's actually going to define our marketplace. I mean, the only thing that's worth looking at in a week like this, I wouldn't necessarily spend a lot of time in technicals and so forth, other than maybe in Nvidia and Tesla. But with all due respect, this week is going to be rather binary. I mean, you're coming into a week where you have a massive announcement. The marketplace is going to be pretty much pins and needles, on that announcement. Do not count out the idea of significant volatility early on in the trading week. Just because the announcement is on Wednesday, everybody assumes, nothing's going to happen over here. Okay. And you're missing the bigger point. The marketplace could actually be positioning itself prior to that FOMC announcement, because you're already seeing that inside of the bond market. The S&Ps might be playing a little bit of a catch-up, if you will. But if you take a look at some of the expected moves in the week, all right, there's some decent amounts of risk. It's nothing like the week before. I mean, the SPX just came off of, it was $157 expected move in the previous week of trade. Volatility got crushed back to basically what? Nominal, like half, like $80 of movement. Nevertheless, okay, there is a huge amount riding on this. Okay, when was the last time that the Fed did not have your back. When was the last time the Fed didn't have your back? And you got to look all the way back, okay? You have to look all the way back to the time frame, okay, of December, and specifically a Fed meeting in December of 2018, when the market actually went into a tirade and, again, downward spiral, even leading into Christmas Eve with one of the bigger sell-offs in there. That was one of the last times that Jerome Powell took a stance, if you will, against the marketplace. What I'm trying to set you guys up for a little bit is, the adage always says, don't fight the Fed. Listen, I'm a victim of that myself. I've been fighting the Fed because the assumption is eventually they've got to mop up all this liquidity. I think we're finally at a point where they are going to start to mop up liquidity, okay? And if fighting the Fed means to be bullish, okay, I'm not sure I want to fight the Fed at this point. Listen, I myself, okay, I do have some bearish positions on. Predominantly, though, I'm selling a huge amount of premium against those bearish positions, and I'm surviving simply because there is an absolutely phenomenal amount of skew. I mean, the skew is still trading in the 150, 147 range, which means those out-of-the-money puts are gold, Jerry, gold, okay? Nevertheless, okay, should you fight the Fed? I don't believe so. And I believe the Fed right now is going to signal something. For the first time in a very long time, they're going to talk about just that, mopping up degrees of liquidity, okay? Actually starting to taper at a more accelerated rate. The term, transitory is out the window. And people, okay, it's markets right now against the Fed. With that, thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.